Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of understanding and managing default risk in investing. Understanding these techniques can help you make more informed investment decisions. Always combine multiple tools and methods to get a well-rounded view of default risk. Mitigating default risk. When investing, one of the key concerns is default risk, the chance that a borrower won't be able to repay their debt. However, there are strategies to manage and reduce this risk. Let's look at 2 effective approaches: diversification and investment in high-quality bonds. Diversification. Explain how diversification can reduce exposure to default risk. Diversification is like not putting all your eggs in one basket. When you spread your investments across various assets, you reduce the impact if one of them fails. Here's how it works. Variety of sectors. Investing in different industries means that a downturn in one area won't ruin your whole portfolio. For instance, if you have investments in tech, healthcare, and energy, a slump in tech won't hurt as much. Range of geographies. Spreading investments across countries can protect you from economic troubles in one region. This international diversification can stabilize your returns. Different asset types. Mix stocks, bonds, and other assets. Bonds tend to be safer than stocks, and real estate can offer steady income. By blending these, you balance risk and reward. By diversifying, you're not dependent on the success of a single investment. This makes your portfolio more resilient against defaults. Investment in high-quality bonds. Discuss the benefits of investing in bonds with high credit ratings. When you invest in bonds, the issuer's ability to repay is crucial. High-quality bonds are those with high credit ratings, signifying less default risk. Here are the benefits. Stable returns. High-quality bonds offer reliable interest payments. They might not give the highest returns, but they provide consistent income. Lower risk. Bonds with high credit ratings come from issuers with strong financial health. For example, U.S. Treasury bonds are considered very safe. Predictability. These bonds are less volatile. Their value doesn't swing wildly, making them a predictable investment option. Investing in high-quality bonds is like lending money to a friend you trust completely. While the returns might be modest, the safety can provide peace of mind. The impact of default risk on investment decisions. Default risk plays a critical role in shaping investment decisions. It refers to the likelihood that a borrower will fail to pay back their debt. Understanding this risk is vital for investors to make informed choices. Risk-adjusted returns. When evaluating investments, it's essential to consider not just potential returns, but risk-adjusted returns. This metric helps investors understand how much risk they are taking on to achieve their returns. Why it matters. If 2 investments offer the same return, but one has a higher default risk, the safer investment is usually the better choice. High returns are enticing, but they often come with higher default risks. Balancing act. Investors aim to find the sweet spot where the potential return justifies the risk. A high return isn't worth it if there's a significant chance of default. Tools and metrics. Common tools like the Sharpe ratio or the Sortino ratio help in assessing risk-adjusted returns. These metrics adjust the return based on the risk level, providing a clearer picture of an investment's true performance. Imagine you're choosing between 2 cars. One is a high-performance sports car, and the other is a reliable sedan. The sports car may be exciting, but if it breaks down often, the reliable sedan is a smarter choice. The same logic applies to investments and default risk. Portfolio management. Default risk isn't just a concern for individual investments. It also affects how portfolio managers design and manage their investment strategies. Diversification. One common strategy to mitigate default risk is diversification. By spreading investments across various asset classes, sectors, and geographies, the impact of any single default is minimized. Credit analysis. Portfolio managers often employ credit analysts whose sole job is to assess the default risk of potential investments. They scrutinize financial statements, market conditions, and other factors to gauge the risk. Stress testing. Managers also run stress tests on their portfolios to see how they would hold up under adverse conditions. This involves simulating scenarios where multiple investments default, helping managers plan for the worst. To put it simply, think of portfolio management like preparing for a road trip. You'd check your car's condition, pack a spare tire, and plan your route to avoid potential hazards. Similarly, portfolio managers take steps to ensure their investments can weather financial storms. In sum, default risk is a crucial factor in both individual investment evaluations and overall portfolio management. By understanding and managing this risk, investors can make smarter, more informed decisions. Case studies of default risk in action. Default risk is a crucial concept in investing, affecting both corporations and governments. Understanding past cases can help investors make informed decisions. Here, we explore notable examples to illustrate the impact of default risk on various types of investments. Corporate defaults. Examine notable cases of corporate defaults and their impact on investors. Corporate defaults are a stark reminder of the risks involved in investing in businesses. When companies can't pay their debts, it can have a ripple effect on stakeholders. Let's look at some famous cases. Enron, 2001. Once a giant in the energy sector, Enron's default shocked investors globally. The company's bankruptcy wiped out $74 billion in assets, leading to massive investor losses. The scandal also exposed widespread corporate fraud, prompting tighter regulations like the Sarbanes-Oxley Act. Lehman Brothers, 2008. The collapse of this financial behemoth is often cited as a primary trigger of the global financial crisis. Lehman's default led to a domino effect, causing credit markets to freeze and stock markets to plummet. Investors lost billions, and the event underscored the importance of credit risk management. General Motors, 2009. When GM filed for bankruptcy, it was the fourth largest bankruptcy in U.S. history. Stockholders lost their investments, and bondholders received stock in the new GM, which was worth far less. The default demonstrated the vulnerability of even seemingly stable companies during economic downturns. Sovereign debt defaults. Discuss the implications of sovereign debt defaults for global investors. Sovereign debt defaults occur when a country fails to meet its debt obligations. These events can destabilize economies and impact global investors. Here are some key examples. Argentina, 2001. Argentina's default on $93 billion of sovereign debt is one of the largest in history. The default led to a severe economic downturn, with GDP falling by over 10%. Investors experienced significant losses, and the country faced legal battles with bondholders for years. Greece, 2012. The Greek debt crisis highlighted the risks of investing in government bonds. Greece's default led to a massive bailout by the European Union and the International Monetary Fund. Investors had to accept a 50% haircut on their holdings, which resulted in substantial financial losses. Venezuela, 2017. Venezuela's ongoing economic crisis culminated in a default on its sovereign debt. The default exacerbated the country's financial troubles and led to a humanitarian crisis. Investors faced steep losses, and the event raised concerns about political and economic stability in emerging markets. Understanding these cases helps investors gauge the potential risks associated with corporate and sovereign investments. Each example illustrates the far-reaching consequences of defaults and underscores the importance of diligent risk assessment. Understanding default risk in investing is crucial. Make informed choices to protect your portfolio. Always weigh the potential returns against the risk of default. Stay updated with market trends. Pay attention to credit ratings. Diversify to spread the risk. Successful investing requires vigilance. Be proactive. Assess and manage default risk to secure your investments. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.